It feels like the biggest mystery for traders learning ICT concepts is daily bias, which I think is because people try to overcomplicate it. In this video, I'll break down how I define my daily bias and important things to keep in mind. Make sure to stick until the end because I'm going to show you my step-by-step process on the charts. So, what is daily bias? Daily bias is to determine where price is most likely going to go in the next couple of days. Are you expecting price to move up and be bullish or to move down and be bearish? Why is it important to understand how to define daily bias? Because trades that you take that align with your daily bias will be higher probability trades and they will most likely move quicker and smoother in your direction. Going against the daily bias is like trading counter trend. I'm not sure if other people mentioned that, but how I personally look at it as well is to determine the trend of the market on different time frames and put them together. So for example, if you have bullish bias, we're in an uptrend, and if you have bearish bias, we're in a downtrend. But there are some significant levels that might trick you if you look at it only that way. But I will add all the details in the examples, and I hope that things are gonna get clear, or maybe confuse you more. Let's see. I'm not like the other YouTubers saying that this is the only thing that you should master and then you're gonna pass your prop firm challenge. Trading is much more complex than that, and you will have to put many things together, both from technical but most importantly from psychological point of view. So first and most important thing according to me is market structure. Is price creating higher highs and higher lows or lower highs and lower lows? Something that we have to keep in mind when we're looking at market structure is the way how price is breaking these highs or lows. Is it breaking with displacement? When price is displacing, it moves quickly and energetically, which confirms that the trend is still strong and will continue. After we define market structure, the next step is liquidity. So what is liquidity? Liquidity is identifying where other traders have placed their stop-loss orders. By identifying liquidity pools, you can anticipate where price might be heading to. Liquidity is like magnet for price. And yeah, I know, there is liquidity below every swing low and above every swing high. Liquidity is everywhere. But there are some liquidity pools that are better to be targeted than others. We want to target low resistance liquidity and avoid targeting high resistance liquidity. And don't worry, I'll show you an example of a low resistance liquidity pool and high resistance liquidity pool. So first, we should note that we are in an uptrend. We can see that we had two buy-side liquidity pools here. Price took them and then broke on the downside with displacement. So why is this swing high a high resistance liquidity pool? Because it took already the previous liquidity, so there is no much liquidity left here. On the other hand, as we can see here, price started creating a trendline liquidity, and there were so many highs that were not liquidated, which means that there is a lot of liquidity left here, and when price is going to target this liquidity, we can anticipate a quick and smooth move through this low resistance liquidity. Why is price moving quickly and smoothly? Because it has no resistance. So as I said, liquidity is like a magnet, and that's why we can see a quick and smooth move here on the upside. If I play price, we can see that this is what happened. Just to give you an example, so let's say if price is here. In this case, we can wait and see what price wants to do. So one thing that I just want to mention is after price took this buy-side liquidity, let's say that price was here and we saw this displacement, then we could anticipate and take shorts while price was engineering this trendline liquidity. But when we notice that we have a trendline liquidity, we can know that those shorts are lower probability shorts, and putting in mind that we're in an uptrend, it will become riskier if we start shorting when we have a low resistance liquidity pool. After liquidity, the next thing is order flow. When you determine what is happening on the higher time frame and you spot the main draw of liquidity, you should go on the lower time frame and wait for the order flow to shift in the same direction. And how do we know if the order flow has shifted in the direction of your higher time frame bias? By looking at price delivery. If price is breaking on the upside and respecting bullish PD arrays, preferably with displacement, then we are bullish, and vice versa. If price is breaking on the downside, preferably with displacement, and respecting bearish PD arrays, then we are bearish. Now, let's put everything into action and define the bias on the chart step by step. Here is a couple of questions that I wrote that you should keep in mind. So first we can start on the weekly chart, and we can see that price is creating higher highs and higher lows. Something that we can see currently is that price is now retracing. We are currently seated exactly on the 50% of the last expansion on the upside, and the weekly highs are still protected. The last weekly high was liquidated, but the previous ones were protected. Another way how that I pay attention to is also if the weekly highs and weekly lows are protected or liquidated. So for example, when the uptrend started, we can see that the weekly lows were protected and the weekly highs were liquidated. So we define the market structure on the weekly time frame. We see that on the daily time frame that we are also bullish. So the first question is, yes, we're in an uptrend. The second question is, where is price coming from? Price is coming after taking a significant pull of liquidity and retracing on the downside. So where are we gonna go, or where is the main draw on liquidity? We have sell side liquidity here, and we have sell side liquidity here. But something that we should always keep in mind is when price starts coming into discount. We know that the overall trend is an uptrend, so currently we're retracing. When we take the Fibonacci, we can see that price is coming into discount. So the first draw of liquidity is definitely this swing low here, but there is no guarantee that price will target this sell side liquidity. So we should just look at the order flow on a lower time frame and see what price is doing and what the market participants are willing to, like on which side they're willing to go. Something that we can see from the order flow here is that after price shifted bearish and the highs were protected and the lows were liquidated, we can see that last week, so when we zoom in, we can see that this was the last extension on the downside. And with the news, we took this high, or we broke the high, but I don't consider this as a break of structure. Why? Because there was no displacement. So I would consider this as a liquidity grab that tapped into this order block for price to continue lower. So my first target would be this sell side liquidity, and after that I will just watch the order flow on a lower time frame to see how price will behave at this level, because this is an optimal trade entry on a higher time frame. So we should be very careful with shorting after price enters discounted prices. If we notice that the order flow remains bearish, the next target would be this sell side liquidity, and we're going to be bearish. So what do I want to see in order to know that my idea is not valid anymore? So let's say price comes and takes this sell side liquidity. I would like to see this high broken on the upside for my bias to shift bullish. Or you can of course look at the order flow on a lower time frame and try when price reaches this level, and that way determine if you want to start going long. But currently, if price breaks on the downside, then I would like to see this high broken on the upside for me to be bullish. If you are not sure about the market structure and you're not sure if something is a break of structure or just a liquidity grab, I can give you a tip to just shift to the line chart, and the line chart is going to give you the clear picture. So as you can see here, we can see that this was the high low that created this lower low. So price didn't go above this higher low, which means that we're still bearish. So let's say if you want to know when price is shifting on the upside, then you would like to line chart to shift from, let's say if we take this sell side liquidity, you want to see price going above this high and start creating higher highs and higher lows. Or if price wants to continue on the downside, then we're going to just see price respecting, creating engineering liquidity, buy side with liquidity here, and respecting these bearish PDRAs to target this liquidity pool that we have here and maybe come and shift bullish from the order blocks that we have here. Something that you should keep in mind is that daily bias does not mean everyday bias. There will be times that you can determine the bias, and in such cases, you just have to wait. Every day is not a trading day, and every week is not a trading week. In trading, patience pays. If you find this video helpful, don't forget to hit the like button, subscribe for more insightful videos like this one, let me know in the comments what you think about it, and if you have any questions, and share it with a friend if you think that it might be helpful. Thank you so much for watching, I appreciate it a lot, trade safe, and until next time.